Something is happening inside the motorcycle market that you were never meant to see, and the truth is uglier than anyone will admit. Behind the polished ads and roaring engines, the industry is quietly collapsing. Dealers are drowning in unsold inventory, financing costs are bleeding them dry, and what looks like growth on paper is often nothing more than smoke and mirrors. This isn't just another slump, it's the most dangerous stall in half a century. And if you own a bike, dream of buying one, or even invest in the companies behind them, what comes next could drain your wallet, shatter your trust, and rewrite the culture of motorcycling itself. Because buried beneath the numbers are stories of collapse, hidden desperation, and an entire generation slipping away from two wheels. Stay with me until the very end, because only then will you see just how deep this crisis truly runs. The stall you weren't supposed to see? The motorcycle market is not idling. It is stalling, mid-corner, in front of our eyes. For decades, this industry carried itself with the swagger of permanence. Motorcycles were more than machines. They were symbols of freedom, rebellion, and identity. But now the engine note is faltering. Sales across the United States have slid into reverse, leaving once crowded showrooms eerily silent. Rows of chrome and carbon fiber sit unsold, catching dust under fluorescent lights, while dealers whisper the word that no one in the business wants to hear: collapse. The numbers tell one story, but the streets tell another. Once reliable segments, heavyweight cruisers, sport bikes, even mid-range commuters, are shrinking simultaneously. In Europe, officials and journalists briefly cheered a rebound, pointing to a rise in registrations. But that bump was a mirage, inflated by riders scrambling to buy pre-Euro 5+ models before regulators slammed the door shut. What looked like healthy demand was nothing more than a clearance sale disguised as a boom. Now that the deadline has passed, 2025 begins with a cliff edge, not a runway. And at the heart of this stall are the dealers, the frontline soldiers of the motorcycle economy. They borrowed to fill showrooms when factories overproduced, and now they pay interest on stock that refuses to move. Each unsold bike is not just a lost sale, it is a bleeding wound on a balance sheet. The market has shifted under their boots, leaving them trapped between manufacturers demanding volume and customers no longer willing or able to sign the loan papers. This is not a seasonal slump or a passing fad. It is the motorcycle market's most dangerous turn in half a century, a convergence of declining sales, distorted growth, and mounting financial pressure that threatens to rewrite the industry's future. And if you think the slowdown happened because riders lost passion, think again. Because what really rewired the market was the invisible hand of money itself. When financing became the enemy, your dream bike did not suddenly get more expensive, your money simply became weaker. Motorcycles are not necessities like groceries or rent, they are discretionary purchases. That means they are hypersensitive to the cost of financing. A $10,000 motorcycle might feel attainable when interest rates are low, but when rates double, the monthly payment swells and suddenly the dream slips out of reach. By late 2024, more buyers were being turned away by lenders or discouraged by the sticker shock of payment calculators than at any point in the last decade. The pain does not stop at the customer. Dealers finance their inventory through what is called floor plan credit, essentially a loan that allows them to stock bikes on the showroom floor. When central banks raised rates to fight inflation, those floor plan charges climbed too. What used to be a manageable carrying cost turned into a margin-erasing weight. Every week a motorcycle sat unsold, the dealer's cost of keeping it grew heavier. This created a vicious cycle. Dealers pushed harder for sales, customers balked at the monthly payment, and more bikes sat idle. In this way, financing became the silent killer of demand. It was not that riders lost their appetite, it was that the cost of money itself pushed them out of the market. And even for those willing to shoulder high payments, another hurdle was waiting. The motorcycle itself was being built with more expensive components before it even rolled into the showroom. If this story already feels bigger than you expected, hit like so more riders see the truth. And drop a comment. What changes worry you most? The silent price hike inside every new bike. Regulations and input costs did not simply nudge prices, they rewrote the bill of materials. Every manufacturer selling in Europe faced Euro 5 Plus standards, which demanded stricter emissions, durability testing, and new onboard diagnostics. None of those requirements are free. They force redesigns, extra engineering hours, and costly certification processes. Add in mandatory safety features such as anti-lock braking systems across more models, and the price of compliance climbs further. But regulations are only part of the picture. Global supply chains still stagger under lingering inflation. Steel, aluminum, electronics, and even rubber all carry higher costs than they did just a few years ago. Labor shortages in logistics and assembly add another layer of expense. When those costs flow downstream, the manufacturer either swallows them or raises sticker prices. In reality, most do both, pushing through incremental increases while trimming margins where they can. This means a mid-sized motorcycle that might have been affordable for a new rider 5 years ago now sits out of reach. Prices are not rising because manufacturers want to gouge. They are rising because the structural cost of building a compliant, modern motorcycle keeps ratcheting upward. And when higher costs collide with higher borrowing rates, riders begin to look for escape routes. Many have not abandoned two wheels. They have simply downsized. The escape to small, cheap, and electric. Riders did not vanish. They downsized. Faced with higher monthly payments and more expensive machines, consumers started shifting toward lower-priced, smaller displacement models. In the United States, the middleweight segments priced in the $10,000 to $12,000 range have remained more resilient than the heavyweight touring bikes that can easily stretch past $30,000. In Europe, commuters gravitate to lightweight scooters and practical adventure machines that offer efficiency at a tolerable price. The sharpest shift came from outside motorcycling. Electric bicycles and scooters, once mocked as toys, exploded in cities. For a fraction of a motorcycle's cost, commuters buy e-bikes needing no license or heavy insurance. Incentives speed adoption, and entry-level riders now choose high-end electric bicycles instead. This change siphons off the very demographic the motorcycle industry depends on for renewal: young, price-sensitive, first-time buyers. Without them, the funnel narrows, and the long-term customer base shrinks. Traditional manufacturers are left fighting to hold on to older, wealthier riders while losing the next generation to pedals and batteries. The immediate effect is clear: fewer motorcycles sold. But the deeper wound is cultural, a slow erosion of the idea that a motorcycle is the natural gateway to freedom on two wheels. And if the riders are shifting their dollars, the most painful consequences will soon be visible not on the streets, but in the balance sheets. As the market shifts, make sure you're staying ahead of the curve. Whether you're buying now or planning for the future, gear up with the right tools and accessories for your ride. Check out the affiliate link in the description to find the best deals on helmets, jackets, and more. The inventory hangover. The industry overbuilt for a party that ended last summer. During the pandemic, when travel was restricted and people sought thrills closer to home, motorcycle sales spiked. Manufacturers interpreted that surge as the beginning of a new golden age. Production lines ran overtime, suppliers expanded, and dealers accepted allocations they once would have rejected. For a brief moment, it looked as if motorcycles had rediscovered their cultural momentum. But demand did not keep pace with that optimism. As interest rates rose and discretionary spending cooled, the excess units began to pile up. Dealers now walk through showrooms crowded with unsold motorcycles, each one a reminder of the optimism that has curdled into overhang. Inventory that once symbolized strength has become a liability. Floor plan financing costs compound the pain, charging interest on every day a bike sits idle. What should be a showcase of fresh models now feels like a graveyard of unsold dreams. Manufacturers cannot simply turn off the tap either. Suppliers rely on steady orders, factories are calibrated for volume, and scaling down production is costly. The result is an uneasy standoff, with dealers pressed to move units at steep discounts while manufacturers scramble to avoid brand damage from fire sales. This imbalance between production and demand is not just an abstract number. It is a weight crushing the balance sheets of companies and dealers alike. And no brand illustrates the stakes more clearly than the most iconic name in American motorcycling. America's icon under strain. When Harley coughs, the whole market reaches for a helmet. Harley-Davidson has been the cultural touchstone of American motorcycling for over a century. Its bar and shield logo is more than branding. It is identity, rebellion, and heritage rolled into one. But even this legend is not immune to the forces reshaping the industry. In 2024, Harley reported retail sales declines that cut across multiple segments. Shipments were reduced, a stark admission that demand could no longer absorb planned production. Leadership transitions further underline the strain. A company that once defined the aspirational heavyweight cruiser market now faces the uncomfortable task of appealing to younger riders who often see Harley as a relic rather than a dream. Used Harleys continue to sell, suggesting that the appetite for the brand persists, but fewer buyers are willing to stretch for new machines with higher price tags and finance costs. Every unsold touring bike on a dealer floor is not just a lost sale, it is a symbol of changing generational tastes. Harley's predicament matters far beyond Milwaukee. When Harley struggles, suppliers tied to its volumes feel the tremors. Rival brands, too, take notice, recalibrating their own forecasts. The whole industry watches because Harley has long been the bellwether. If its core loyalists hesitate, the broader market is truly in trouble. And while Europe seemed like it might offer a reprieve, the reality behind the numbers there tells a different story. Europe's mirage of growth. Sales were up because the deadline was full stop. On the surface, 2024 looked like a strong year for the European motorcycle market. Registrations spiked, journalists declared recovery, and some manufacturers dared to hope the tide was turning. But the reality is that the numbers were distorted by a looming regulatory cutoff. Euro 5+ standards, which tightened emissions and durability requirements, created a cliff. Buyers rushed to secure pre-compliant machines before the rules took effect, and dealers cleared inventory with aggressive discounts. That surge inflated the books for 1 year, but set the stage for a slump in the next. As 2025 begins, dealers confront a demand vacuum. The customers who might have bought this year already purchased last year, leaving showrooms quiet. For smaller manufacturers, the burden is even heavier. Compliance costs fall harder on lean operations, and many lack the scale to spread engineering and certification expenses across wide product lines. The same regulations meant to clean the air have effectively thinned the herd of smaller brands, making survival a question of capital reserves rather than customer loyalty. Europe's supposed growth then was less a renaissance and more a mirage. The short-term gain disguises the long-term fragility of a market forced into artificial cycles by regulatory deadlines. And just as Europe's illusion begins to fade, another competitor has emerged to claim the urban streets. A competitor that is not even technically a motorcycle. The micro-invasion. Half the battle for entry-level riders was lost to pedals and platforms. The rise of micro-mobility has rewritten the entry point into two-wheeled transport. Electric bicycles and scooters have surged across cities, offering commuters an accessible, low-cost, and regulation-light alternative. Where a motorcycle requires licensing, insurance, and significant investment, an e-bike can be bought for a fraction of the price and ridden immediately. For a generation raised on app-based convenience, the appeal is undeniable. Cities fuel the shift with bike lanes, charging hubs, and fewer motorcycle spaces. Campaigns frame motorcycles as hazards, but e-bikes as green. Despite rising e-bike injuries, adoption grows. Many riders who once started on 125 cubic centimeter motorcycles now choose electric scooters for cost and convenience. For the motorcycle industry, this is a double wound. Not only are new riders being siphoned away, but the broader cultural pipeline that feeds motorcycling as a lifestyle is eroding. Without a steady influx of beginners, the market ages, the base narrows, and growth becomes harder to sustain. And if micromobility has already begun to win the battle for hearts and streets, the next blows will fall squarely on the factory floor and ultimately on your invoice. Compliance isn't free. Every cleaner bike comes with a dirtier spreadsheet. Regulations have become the invisible passenger on every motorcycle that rolls out of a factory. Euro 5 Plus standards have introduced tougher emissions thresholds, more rigorous durability testing, and expanded onboard diagnostics that monitor compliance over time. None of this comes cheap. Manufacturers must redesign engines, add sensors, and retool factories to meet these ever-tightening rules. Even before a single unit is sold, millions are spent on engineering, certification, and validation. Regulation costs keep rising. Climate targets to 2050 mean tougher limits on emissions, noise, and particulates. Each cycle demands more staff, prototypes, and testing. Smaller brands without scale face existential strain, some exiting categories rather than re-engineering for thin-margin markets. Consumers rarely see this paperwork side of motorcycling, but they feel it in the showroom. The cost of meeting Euro 5 Plus does not evaporate. It filters down into the retail price of every new machine. What was once an affordable path into riding now demands a thicker wallet. And as these compliance costs swell, another layer of financial turbulence is waiting, driven not by regulators but by tariffs, freight rates, and the unpredictable tide of global currencies. Tariffs, freight, and the cost of capital. Policy did not just move the goalposts, it moved the whole stadium. Motorcycles, like many manufactured goods, sit at the mercy of global trade dynamics. Tariffs imposed between trading blocs can add hundreds or even thousands of dollars to the cost of a machine. A commuter bike that should be an affordable option becomes a luxury purchase once import duties are added. These tariffs change not only prices but also supply chain strategies, forcing brands to rethink where they build, how they ship, and which markets they prioritize. Freight costs add another unpredictable variable. During the pandemic, container prices surged to record highs. While those spikes have eased, volatility remains. A shipping delay or sudden rise in rates can erase thin margins on lower-priced models. Currency swings pile on further uncertainty. When the euro weakens against the dollar, or the yen fluctuates against the rupee, the profitability of an export can swing from gain to loss overnight. Capital itself has grown more expensive too. Investors facing rising yields on safe government bonds are less willing to back riskier assets like dealer inventory loans or manufacturer debt. This mirrors what happened in the housing market. When safer returns are available elsewhere, capital flees discretionary sectors. The result is a more fragile ecosystem for motorcycling, where small shocks reverberate more sharply. And while policy and currency reshape the balance sheets, the bigger question looms. Who are the customers that still buy motorcycles in this environment? The answer is not who it used to be. The new rider isn't who you think. It is not a midlife crisis anymore. It is a budgeting exercise. The archetype of the motorcycle buyer as a middle-aged man splurging on a cruiser no longer defines the market. Instead, a younger, more diverse generation is stepping in, though cautiously and with different expectations. These riders are often urban, seeking affordable commuting solutions rather than weekend luxury. They demand connectivity, smartphone integration, and lower operating costs alongside style and performance. Adventure bikes in the middleweight category have thrived as a result, offering versatility at prices that undercut heavyweight cruisers and tourers. Commuter-friendly models that sip fuel and slide through traffic also show resilience, while high-end aspirational machines see slower turnover. The cultural pull has shifted too. Social media and community riding clubs highlight inclusivity, drawing in women and riders from backgrounds that legacy brands once ignored. This broadening of the rider base is promising, but it comes tethered to budget discipline. Financing terms, insurance premiums, and service costs weigh heavily on decisions. Brand loyalty has weakened in this environment. A younger rider will switch to whichever manufacturer offers the best deal, the most reliable commuter, or the most compelling technology. Legacy prestige means less than monthly affordability. Manufacturers must confront this reality. The customer they built for decades ago is not the customer walking through the door today. And if buyers change while costs rise, then strategies must flip or break entirely. Survival playbooks, cut, pivot, or platform. Some builders still sell bikes. Others are starting to sell ecosystems. Faced with rising costs, shifting demographics, and financial uncertainty, manufacturers have begun to choose their survival playbooks. Some have opted for cuts, slashing production runs, and trimming product lines to protect profitability. Others pivot towards segments showing life, especially commuters and mid-size adventure bikes, where volumes can be defended. Dealers cautiously push promotions with financing deals, subsidies, and service bundles to keep sales alive. Forward-looking brands expand beyond bikes, investing in accessories, apps, and subscriptions. Each rider becomes a recurring revenue stream, part of a wider ecosystem spanning gear, maintenance, and digital communities. This diversification is not optional, it is survival. Relying solely on unit sales is too risky in a market where regulations, financing, and competition are squeezing margins. Those who adapt can weather the turbulence, but those who cling to old models risk obsolescence. And as these strategies unfold, the stage is set for the broader shock of Part 4, because the ripple effects of this crisis will not stop at dealerships or factories. They are about to spill into politics, supply chains, labor movements, and consumer wallets. You've seen how deep this crisis runs, but we're still not finished. Subscribe now, because the next chapters will uncover the ripple effects no one is talking about. Don't miss what's coming next. This isn't just about motorcycles, it's about your future. Stay tuned and stay ready. Dominoes in the supply chain. When OEMs sneeze, suppliers catch pneumonia. The motorcycle industry is not just the famous badges on fuel tanks. It is an ecosystem of thousands of suppliers that provide everything from engine castings to wiring harnesses. When production slows, these smaller firms feel the impact with brutal speed. Tier 1 suppliers must repeatedly revalidate their components under Euro 5+ compliance, which means spending money on testing and certification even as volumes decline. The same exhaust that once spread across 50,000 units now has to carry the cost burden of 30,000. Margins evaporate and cash flow dries up. Dealer inventory troubles also ripple upstream. Unsold bikes mean manufacturers hold back on orders, which in turn means suppliers slash their forecasts. A plastics company that once delivered parts for multiple models may suddenly find half its contracts suspended. These domino effects accelerate bankruptcies among mid-tier suppliers who lack the financial reserves of larger conglomerates. The consequences stretch beyond balance sheets. Once a supplier folds, it is nearly impossible to replace overnight. That gap delays production further, creating shortages even in models that still enjoy demand. Every player in the supply chain understands the stakes. What looks like a slowdown in the showroom becomes a crisis on the factory floor and a near-death sentence for smaller suppliers. And just as the industry grapples with this cascade, another force emerges, not mechanical, but political, because politicians and regulators are increasingly choosing who gets to ride and who does not. Politics will pick winners. If you think this is just about bikes, you have not read the rulebook. Urban planners and regulators are writing policies that tip the scales in favor of micromobility while tightening restrictions on traditional motorcycles. City governments pour millions into bicycle lanes, charging hubs for scooters and subsidies for e-bikes, while simultaneously reducing motorcycle parking and tightening noise ordinances. The message is clear. The preferred two-wheeled future is electric and pedal-assisted, not gas-powered. Emission standards climb, forcing costly redesigns. Tariffs distort prices, making imports from India or Thailand uncompetitive in Europe. Political winds, not consumers, decide winners. Governments frame it as safety or climate while quietly protecting domestic brands and pressuring foreign rivals. For riders, this means choice is narrowing even if variety appears to expand. A showroom may display dozens of models, but policy pressure determines which survive 5 years down the road. Manufacturers have to anticipate these shifts or risk being locked out of entire regions. And while politics shapes the playing field, the human consequences are already emerging on the factory floor. Workers are beginning to push back, demanding that they not be left behind in the rush to a re-engineered future. Labor's next ride. When the line stops, the picket signs come out. The motorcycle industry is deeply labor-intensive, from welding frames to assembling engines. When production slows or shifts to electrification, the immediate casualty is jobs. In Europe and the United States, unions have already raised alarms that the transition to electric two-wheelers could leave thousands of skilled workers behind. Building an internal combustion engine requires a different set of expertise than assembling a battery pack, and retraining is neither cheap nor guaranteed. Factory slowdowns translate into layoffs, furloughs, and growing frustration. Workers argue for a just transition, where governments and manufacturers share responsibility for reskilling. Dealer staff feel the squeeze as well. With inventory sitting unsold, sales commissions dry up, and service departments lose future business. The pain ripples outward. Fewer jobs mean weaker local economies in towns built around motorcycle plants. Labor unrest is not hypothetical. It is already surfacing. Strikes in related automotive sectors show the path that motorcycle workers may soon follow. The symbolism of workers rallying to protect both livelihoods and heritage cannot be ignored. Motorcycles have always stood for freedom and independence, but inside the factories, the fight is increasingly about security and fairness. And as workers mobilize, another group is watching closely: the consumers and investors who will ultimately foot the bill. What this means for your wallet. Bikes might get cheaper to buy or dearer to own. For consumers, the immediate silver lining of the industry slowdown is the wave of discounts on leftover stock. Dealers desperate to clear floor plans are willing to cut deals that would have been unthinkable 2 years ago. A savvy buyer might walk away with a bargain on last year's model, but the relief is temporary. In the long term, the structural cost of compliance, higher freight, and more expensive financing will push base prices higher. Today's discount is tomorrow's markup. Ownership costs are also rising. Insurance premiums are adjusting upward as claims data grows, and financing terms remain stricter than before. Even routine maintenance may cost more as supply chain disruptions drive up parts prices. For riders, the calculation becomes not just whether they can afford the sticker price, but whether they can manage the lifetime expense of keeping a motorcycle on the road. Investors face their own balancing act. The industry's cyclicality makes motorcycle stocks volatile, and every change in tariffs, credit markets, or consumer demographics sends ripples through valuations. Hedge funds and pension funds alike are watching the sector, weighing the risks of regulatory overhang against the opportunities of consolidation. For both buyers and investors, the motorcycle is no longer just a machine, it is a financial signal. And as we close this story across 16 chapters, the truth is clear. There is no way back to the industry we once knew. The story doesn't end here. Share this video so more riders see the truth, and subscribe now so you never miss what's coming next. The road ahead is changing fast. Don't get left behind.